Welcome to Idea to IPO. Hello, my name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,447 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize and produce venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. At this point, I'm going to hand it off to our distinguished moderator, Jason Putnam Gordon. Jason, take it away.
Terrific. Thank you very much, Rob. It's great to be here. It's been a pleasure to work with you over the last several years and great to work with you virtually. As Rob mentioned, we've got a great panel today. We're going to be focused on investment and innovations in media tech. My name is Jason Putnam Gordon. I'm a venture capital and emerging growth company attorney with Polsinelli. Polsinelli is a 900 attorney Am Law 100 firm. My areas of practice are artificial intelligence, robotics, IoT, and health tech. Today, our panel is Joe Jason with DNA Partners, Nunu Gonzalez Pedro with Strive Capital, and Honam with Altos Ventures. Before we begin the panel, I would like to go over the structure of today's event. What we're going to do is the panel is going to speak for about an hour. If you've got a question, please use the Q&A function within Zoom. Please do not use the chat function. We will be looking at the chat function, but we're not going to be able to catch all of the questions if they come in that way. I'll remind you. As Rob mentioned, or may have mentioned, today we're recording. So if you miss some or all of today's panel, we'll send it to you afterwards if you've registered. Additionally, that means that it is recording. So if you ask a question or you submit something that is confidential, please don't do that because it's going to be a public venue. The other issue that comes up sometimes is that I am not only hosting, but I'm also running all the back end here. So if you see me kind of looking around, futzing, it's not because the panel's not interesting. I know they're going to be interesting today. It's because I got to run the back end. So forgive me for any of that. Now, what I'd like to do is run a quick audience survey or poll so we get a sense for who's in the room. It's also going to tee up today's conversation. And while we do that, what I'm going to do is I'm going to ask each of the panelists to introduce himself, provide the contact information that they may want to, that they would like to use if they want you to contact them, and tell you a little bit about who they are and what their area of expertise is within media tech. We'll start with Ho.
Okay. Honam, Altos Ventures. We're an early stage VC firm that got started in 1996. So we're definitely well into our 25th year. We invest globally. So even though we're headquartered in Silicon Valley, we actually opened up a Seoul, Korea office in 2013. We started with about $30 million of capital, investing in all sectors of IT. And now we have about close to $5 billion, I think under management across various funds we've raised over the years. One of the distinguishing qualities of Altos that's different than a typical early stage firm, though, is that we are registered with the SEC. So we're an RIA, which allows us to do later stage investments, secondary public investments as well. But we don't do later stage investments of other people's companies. We basically will follow on with a small number of our companies and build it to scale. And so one of the things that's unusual about our early stage profile is that we never run out of capital. Every fund is able to invest in an existing portfolio company from, it could be from multiple funds ago. And so if we like an interesting company, we might stay with the company for a really long time across multiple funds. Starting with single digit millions of dollars, we could put tens of millions, in some cases, hundreds of millions of dollars. We could do $100 million kind of a single round investment. even though the initial investment may have been only $1 million. So that's something that's a little bit different about Altos compared to other early stage funds. And that's it. I'll pass it to some of the other panelists.
Nunu?
Sure. So I'm the managing partner and founder at Strive Capital. We've been around for less time than Altos Ventures, for 10 years now, since 2010. We focus mostly on consumer or consumer-like investments. So I'd say software as a service, but more the bottom-up side of it. Pure consumer investments. Claim to fame is our first fund was likely the first quant or analytically driven early stage fund in the Bay Area. We actually derived a significant part of our deal flow from analytics engines that we built in-house. We also use those analytics engines to help us with due diligence. We are now on the verge of our third vehicle. Again, very early stage focus, so Series Seed classically in the Bay Area, sometimes even pre-seed. Series A in other parts of the world, multi-geo, a little bit of a contrarian. Not that I like being a contrarian, but I like finding sort of the hacks that then lead to scalable operating models and changes. On top of that, I co-host DecipheredShow.com, which is Tech Deciphered, which is a podcast with Bertrand Schmidt, the co-founder and chairman of App Annie, a company that I also invested in. And some of my more notable investments involve companies like App Annie, Gusto, Rubrik, and then on the consumer side, DraftKings, Robinhood, and a few other companies that are very exciting, like KeepSafe, et cetera.
Thank you. Wonderful to have you here, Joe.
Greetings, everyone. Happy to be here. Thanks to IDEA to IPO. This is a good topic today. It's exciting, a little bit refreshing for Silicon Valley. Once again, my name is Joe Jason. I'm a partner at a firm called DNA Partners. We're a seed investment firm, 50 to 500K. Our vertical that we invest in is, we say, digital media value chain technologies. So software in digital media, software in infrastructure of digital media, meaning end-to-end, the value chain end-to-end. Software, again, I'm going to say it. Our geographies are USA, China, and for the last 2 years now, we've been doing a lot of due diligence on the Philippines, and we're just starting to get to know great actors in the Philippines, like the mobile network operators, incubators, regulators, and the US Department of Commerce there has been helping us out a lot. Just want to say, this is great, and I'll be highlighting certain technologies and industries that we want to participate with. And thanks for having me here today.
Wonderful. We're delighted to have each of you here today. So we've completed the polling results. We've got about 2/3 of the answers in. I've shared them with everybody, but just to highlight what we see here, we've got about 50% of the folks located in the Bay Area, with the next biggest draw would be somewhere else in the US or Europe. Again, this is going to be recorded, so there are probably a number of folks who have registered and will view the video not in real time. We've got 43% first-time entrepreneurs, 13% serial entrepreneurs, and then the next biggest bucket are the 1/3 other. So I'd be curious to see how those folks are. And in terms of the level of affinity for LinkedIn, it looks like most folks have found it fairly helpful for their professional career. The distribution seems to be kind of centered mostly around 7 to 8 or so. So with that in mind, I think it's always helpful to start these panels off and to have a conversation and first focus on what it is that we're talking about. And Ho, you and I were chatting about this a little bit earlier, but how is it that you define media tech? What are we going to talk about today when we're talking about media tech, at least in your mind?
Yeah, well, we define it pretty broadly, but the sector of media tech that is most interesting to us is really interactive media. It could be gaming, it could be social media, it could be a video dating, a type of situation where it's really user-generated content, video broadcasting. We also have an investment in a company called Spoon Radio, which is really a spin on audio content, not podcasts. It's really live, and it's quite an interesting phenomenon. So we're just seeing a lot of innovation everywhere around the world. Spoon is an example of a company that's really not very big here, but they're big in Korea and Japan. We have a company called HyperConnect, which has several different apps. Azar, which is this video chat dating app, but Hakuna is this video broadcasting app where individual creators could basically host little seminars like this. Basically, it's like Spoon Radio on video. So it's been quite fascinating to see the evolution. And we also have some traditional entertainment kind of content, but where, Korea, K-pop and Korea movies, Korean videos, Korean dramas are really big. And so some of our Korean investments have taken that traditional media and taken it abroad. And so we're seeing both traditional media taking advantage of new distribution channels, going from TV to YouTube or TikTok or whatever, as well as just completely new types of entertainment that we have never seen before.
Fantastic. Joe, how does that jibe?
Oh, that's great. I think that's great. And that's a lot of B2C initiatives and distribution and content creation and content curating. For us, it's more about anything digital. So internet, app, whatever. I mean, client server software, web, HTML5, but also, internet type services, intranet type services, and extranet type services. We also count as media. Just anything transported, for B2B, B2C, B2G. So that's where we fall into place.
Anything to add, Nunu?
Yeah, so for us, we have also a very broad definition, but we start from the top. We think through what is content that has a value that goes beyond a very small group of people, right? So normally we'll look at content that gets developed, and by content we mean audio, video, messages that have a value either to an intrinsic community, so it's more like what we could call potentially niche content, or very mass market appeal, right? Beyond just a very niche appeal to it. And so then the way we look at it is all the enablers to that content, which means content developers. So for example, we look very heavily at mobile gaming studios. We've actually done some really good investments in that space. One of our first investments in our first fund was a Japanese company that IPO'd within 2.5 years, right? That was doing mobile social gaming and doing online to offline and doing all the things that were really core aspects to it. The second piece of it is obviously the content aggregation. So, curation of content, putting things together, distributing it, etc. There's obviously then an element of fundamental distribution of content. How do you get to people? And that's why, for example, now all these social networks are all in the news because they've become massive distributing elements to the market. But we also go below. So we also look at platforms. I wouldn't say we spend a lot of time around the infra piece, so the infrastructure of codecs and decoders and all of that stuff. But we do spend a lot of time around platforms as well that are core enablers to the media stack. So for us, verticals that would fall into this would be gaming, where we spend a lot of our time. It would be what we call broadly media and entertainment, which is more of the media angle to this. But it could be other things. It could be, social, for example. We're spending a lot of time around social right now. We have a very core belief that social is going to be hot again because we have a generational shift going on from millennials to Gen Zers, and the tools that they want to convey their thoughts and how they want to interact are not necessarily different. I think TikTok is sort of and Douyin are sort of the top of the iceberg. We're going to see a lot of more shifts around how people communicate and how they interact socially going forward.
I just want to identify a sector. So, Nuno, you intertwined content, creating content, and technology. So today's theme is media technology. So I just want to highlight to our audience that some investors consider content media technology. So it's a difficult fusion to try to pull apart or put together. So if you have questions, just make sure you're specific. Is it content or technology?
Yeah.
And then of course we know that technology transports the content, and there can be hooks or intellectual property inside a content creator and how they want it transported.
Yeah. And
yeah,
I think
and sometimes it's really hard to separate the two. We have a bunch of companies that are pure technology companies. We create no content. but all the value, the reason people come to the platform is the content, right? So a good example is like a Quizlet, which is kids creating flashcards or teachers creating flashcards to learn. They create no materials whatsoever. It's a pure technology company. Or we have a company called Insight Timer, which is about meditation, right? And we have all kinds of tools to enable meditation teachers to develop a following and create a business. And we're connecting teachers and meditators, right? Or Roblox is an example of, again, it's a game company that never creates any games. It's about millions of creators who are creating the content, and then hundreds of millions of players coming to find that content. So I think there are a lot of technology companies, and really they're not very good at content at all. But the content is what is the key to driving all this interactivity, right? Yeah.
And just reacting to that, because I think Joe's point is actually a very powerful one. We would invest in companies that are core tech enablers, precisely to your point, Ho, that they're trying to actually become the conveyor, for example, of user-generated content, which is obviously a huge trend that we've seen over the last decade and a half. But at the same time, we would rarely invest in a company that just does content without a technology element to it. And for us, that is the element of scale up, right? So to give you a very precise example, we would invest in a gaming company because they are a technology company. They are developing typically their own platforms. As we've seen, there's actually even companies that are miserable failures as gaming studios that end up, spinning off, like App Annie is a spin-off of a gaming company, right? Slack is a spin-off of a gaming company. Discord is a spin-off of a gaming company. So they generate such great tools internally. They're so good at technology that actually their games have no value, but their technology does. So in some ways, we do still invest more on media tech or just tech by itself that is a core enabler to media. We rarely invest in stuff that's just content. That is we just do content and there's no scalability to how we produce it and go to the next level.
I would say Pixar is a great example of a company that does content and technology, right? You need both. And Disney is, of course, taking that playbook. They're an amazing content company. They have all this amazing IP with Star Wars and Marvel and all the Pixar content. And then they're forced to develop technology, acquire, develop, build, like Disney Plus. And you have to have both in this day and age. I think if you're just a content company without some technology, I think that's going to be tough. I think it could be a pure technology company. And I think you can do both. But I think if you're just pure content, I think that's going to be tough.
We stay on this topic just a little bit more. And what I'd like to do, Ho, you and I were talking about this a little bit earlier, but in the sort of blend of content versus technology, could we share with the audience a little bit about how, what's changed in the recent past and what we see kind of moving forward in terms of the evolution of the technology and the infrastructure that's enabling some content providers to become more technology oriented, some technology providers to become more, some content providers, well, the other way around. And what we see kind of coming down the pike. I know, Joe, you got a particular area of interest in terms of the 5G. So there's a lot out there, a lot of opportunity.
Yeah, I would go to that's a good enlightenment. You go to something like a Akamai CDN. It's been around a long time and distributing content, make it all faster for us. And then you can have 5G, and then Akamai could distribute on 5G. So it's great. So it's in the ground in the wired broadband domain, and then above ground in the 5G broadband domain. So I don't know if you want me to elaborate any more.
I maybe just adding to it, I think the biggest transformation is really the digital transformation, which is internet and then the mobile internet. I think those are the two big shifts. And I think we're still actually seeing effects of the first big shift, which was the internet, not just the mobile internet. Although the mobile internet shift has probably been more dramatic because it's put it more in the hands of more people around the world in emerging markets, et cetera. Those two big shifts are here to stay. And that what has meant is you can't just do content. You need to figure out how that content fits with that audience. And, I think, now Quibi is in the news and they're going to be the laughing stock for a while, but they were trying to do something fundamentally different. They were trying to go back to the playbook of a decade ago, a decade and a half ago, where we had a lot of pure plays that said there should be shorter form content for mobile, and it needs to be enabled in a different way. We can discuss why Quibi didn't work, et cetera. I have my own thoughts about it, but more precisely, I think that what has changed is you have to have a core differentiator around a lot of the elements of what you're doing. And one is the element of actually getting distribution cleared and having a good angle on how to get this in the hands of people, right? Netflix took them a while, but they got there. And they were advantaged by the fact that they started with DVDs. They started with physical stuff, right? Actually, there was an advantage to that, right? And that business actually hasn't fully died yet, from what I've heard. So it's still around somewhere. Anyway, so that piece of how do you get to your customers, what value do you serve to them, is still there. But then there has to be something else. There has to be a great user experience, and that is anchored around technology. There has to be a great user experience that, for example, in terms of reliability of video and where I'm watching it, we take it for granted today with YouTube and with Netflix and all that stuff, but we can go back 5-10 years and the experience on mobile was fundamentally crap. Right? The peering agreements with telcos weren't done. They haven't figured out how are they going to serve this in a different way, et cetera. And so there's a lot of the elements of the stack that are fundamental technology. How do you make money? It could be advertising. And then how do you serve the right advertisements to the content that you're putting forward? So I think it's becoming more and more intrinsically linked to technology, certainly from the operating model standpoint. And I don't see that going away. If I take actually one step back, if we look at social as sort of one of the core channels of new media, not only in terms of distribution, but also even in terms of creation of content, like we look at TikTok. I mean, TikTok is content, right? It's user-generated content at scale. Facebook, we could say it depends, but it's probably more of a distribution channel today. It could evolve, right? At the end of the day, social has become a way of conveying this. But if we look then at social, then we look back at communications and messaging and how we talk to each other person to person, and how some of these tools have actually scaled to content like Snapchat. So in some ways, all of these things are sort of collapsing, and media has been consumed across different mechanisms, and it's being created by all sorts of people. And so I don't think we're going to come back from that. We're going to have very high value production content, Netflix, HBO, et cetera. And we're still going to have great content that gets scaled in terms of creation through these tools by you and I, that can just have, now I've heard now it's cool for VCs to be on TikTok and sharing advice. I'm like, I'm on TikTok. I'm still figuring out what content I want to share. I'm not sure I'm going to do it in a cool way, but who knows, right? But that's become a thing as well. So for me, that's the cool thing. It's becoming intrinsically more technology driven, but it's also collapsing in terms of categories, and that's interesting. I think that's fundamentally interesting.
I mean, it sort of seems, just to echo what you're saying in terms of the internet shift, the pipes are getting bigger, right? And you're able to get more data through there. And then with regard to the mobile evolution, it's sort of being untethered to a certain extent. Ho, what are your thoughts?
Well, look, I mean, long before the internet, technology has always impacted media and content, right? You have the printing press. It's like, okay, well, that kind of enables a whole new industry, publishing books, right? Or you have the phonograph, and records songs had a certain length because that was a limitation of the technology, and then it created all kinds of other kind of business models and how to monetize it to retail distribution channels and the radios and promoting these records through the network radios. And then you have, like, Netflix is another great example where, because the fundamental technology shift, they started to go from movies to TV, right? Serial binge watching, right? Because if you don't have to wait 3 days for the next movie to arrive, and you could immediately go to the next thing, it just completely changed people's viewing behavior, and it changed the kind of content that gets created. Right, so a technology shift to streaming changes the entire entertainment industry, right? And so many more dollars, hundreds of millions of dollars, are being devoted to creating the kind of content that wasn't being created before, ever. So technology has had a history of influencing the content for a long time, hundreds of years.
Oh, to the one point that you made that's really, really important and powerful is it aligns so much with tech that the way we've been measuring, and I think it's happened mostly in the last decade and a half, that we've been measuring the success of a tech product is around retention and engagement of users. It's about repeat use of something and how much time they spend with us. And in some ways today you look at media and it's the same thing. You're going to talk to someone at Netflix, it's no longer about the number of subscribers they have. They are measuring the retention engagement they have on each of their shows, the return on investment that they're getting on each of their shows. They're getting super precise around the unit economics that lead to highly retained and engaged users. And again, that aligns very well with the tech evolution we've seen over the last 10, 15 years, with software as a service emerging on the enterprise side, with a lot of the consumer mobile apps, et cetera. So again, the metrics are getting even more similar, right? So success is measured by the same things, literally. You could
Yeah.
be
Well,
looking
the
literally
really
at cohort
interesting thing
analysis
is,
across, yeah.
yeah, whether it's gaming or radio or a podcast or whatever, like the one metric that you equalize everything is just number of hours. Like it's all about eyeballs. So are you spending 40 minutes on Facebook or 40 minutes playing a game or 40 minutes watching YouTube or Netflix? And we're all fighting for the same kind of attention at the end of the day. So if we have a company called Open Sesame, which is in the B2B space and B2B video content, for a corporate education, things like that. And we pay our partners, content partners, based on the number of hours of engagement. That's exactly the metric that Netflix uses to measure engagement. Facebook cares about minutes of engagement. I'm sure TikTok does as well. Our company Roblox, same thing. Like we measure it now in terms of the billions of hours per month. But it's like, yeah, that's what counts. Is do you have the people's attention, right? How many minutes a day or hours a day do you have?
So I think that's a great point, and I'm very mindful of the fact I think we've got about 44% of the audience are first-time entrepreneurs, and so I think what is always really helpful is to sort of take that kind of information, then unpack it for them a little bit, so that they can understand what a VC and ultimately the market is looking for, or rewarding when they're capturing those minutes, and how does that sort of get monetized.
So you're talking about monetization, how you then make money out of these services?
Yeah, sort of
Is that the
transitioning, but also like, how is it that you view it, right? So,
Look,
they come in and say, we're going to get,
it's pretty simple. There's a couple of known playbooks, right? There's the ad-based playbook, difficult to execute as hell. Programmatic advertising during COVID is going through a bit of a slump. It's difficult to get the right ads linked to it. I'm assuming this is an audience that also has interest in media tech specifically, so adapting a little bit more to that. But that's clearly a business model. The model of advertising is still there. There's still high value advertising. The more niche you are, the more you can command per CPM, per CPA, et cetera. So there's obviously a lot of angles around advertising-based business models. It's less cool than it used to be. I think by opposite, we had subscription that was not cool at all. And I remember we invested in a privacy-based company called KeepSafe. They're not really in the media space. They're more in the hiding your own media space. And actually, they were one of the first guys that started, charging for their service directly to consumers in 2013 in this space. And, they've done incredibly well. And part of it is, now subscription's cool. Everyone's like, oh, now subscription's cool. And I think we're going to get to a point where subscription is also too much, right? There's too many services right now, too many video streaming services with Disney Plus, Peacock just came out, all these things. And people are like, you know what? I'm not going to buy all this stuff. I can't buy it. So at some point, people are going to be rational and rationalize back. But subscription-based business models, I think, can still scale. I think the nail on subscription-based business models is you have to have a utility value that's significant to people. You can't just have the addiction piece. It has to be that element of it. And then there's a lot of stuff, other alternative business models. Without say, I would highlight freemium, right? I mean, freemium changed how a lot of content is consumed, particularly in gaming. It was sort of the single biggest revolution of gaming because it allows people to consume free for a period of time and maybe even forever. But if they want to go more hardcore, if they want to become the top X player in that game, et cetera, they need to pay something. They'll need to start paying. And this comes from a variety of sources. It could be subscription. It could be incremental revenue from virtual items. It could be the whole economy of the game and how it's managed, et cetera. So again, I'd say there's a lot of playbooks. These three are sort of the ones that are in everyone's head today. Obviously, there's others. Advertising is probably less cool than it used to be, also because of elements of privacy, and people are a little bit more suspicious about advertising. Subscriptions become, I think, way too hot. I think we're going to have a downfall of subscription. Freemium is there; it just works, right, in certain categories, and I don't think it will stop working. Even in software as a service, freemium has worked really well.
Yeah, and I characterize the freemium model as just a transaction. So transactional business model, subscription business model, and advertising business model. And all three can be fabulous. If you're an amazing business like Amazon, you have all three, right? The retail is just a transactional business, but then they added Amazon Prime, which is this amazing subscription business. Like Costco has this amazing subscription base, loyal customers, and they make all their profits from their memberships. And then you could have advertising, and Amazon's become a multi-billion-dollar advertising business as well. And so I think that in advertising, the most interesting advertising businesses though are not the typical advertising businesses. But if you could get big enough, if you have proprietary content, proprietary, again, mind share engagement with your audience, once you're big enough, you can have an ad unit that does not exist anywhere else in the world, right? It's a specific ad unit just for your platform with your audience, and however way you engage your audience. And if you get that big and you have that kind of an interactivity with your audience, that particular business model could be very interesting. So there's advertising you buy only on Google, only from Google. Like there's advertising you buy only on Twitter or Facebook. So I think that could be interesting if you get that big. Subscription, everybody loves subscriptions. There's a very high premium on subscription, probably too hot, as Nuno says, but it's nice recurring revenue relationship. But I think the best businesses always create this recurring revenue models, and you don't have to lock in somebody to a contractual subscription arrangement, right? Starbucks coffee, maybe it's an addictive product. They have an amazing relationship with their consumers, with their customers. They don't try to lock you into some subscription contract, but it's a recurring relationship. Coca-Cola, they've had a recurring relationship with their customers for 100 years. So if you have a great product, customers will keep coming back. You have a recurring revenue stream, but it doesn't have to be a contractual revenue stream. So transactional revenues, I think, to me, is the most interesting. And that's where we've seen the most innovation, because that is kind of new or a lot more innovation with the internet than subscriptions, which have been around for a long time, and advertising has been around forever as well.
So I guess one of the things, shifting gears a little bit, and we kind of see some technology that is emergent and still developing, would be in the AR, VR space. And I'd be interested to get your take, especially on the AR side, Joe, what you maybe see with regard to 5G being able to enable that, and how that might, what kinds of interesting plays there might be coming down the pike.
Great. I'm glad you brought it up. I am going to take one step backwards, which always drives the audience, bat crazy. But I think the last two panelists have encapsulated the present tense business models and businesses for B2C in digital media. We did have transaction before subscription as the main business model. Just wanted to highlight that. And then also Quibi's business had been done in Korea and Japan before in the mid 2000s, like 2005, 2006. SK Telecom and NTT Docomo did their own content creation for mini-sodes of soap operas and movies. So they were paying about $500,000 per episode. So I just wanted to highlight, did Quibi do their research on that and figure out why that did not work? It could have been handsets, the lack of smartphones. There were smartphones then before the Apple smartphone. Many, many, many smartphones in Korea and Japan before iPhone, many. And so I just wanted to highlight that. And then maybe Quibi didn't have the opportunity because of COVID. I'm just highlighting that because it could be a decent reality where people are not out of their house. Mm-hmm. They're not driving their car. They're not standing in line at Costco, right? They're not, it could have had something to do with it. But we also all know that, I'm going to say something on the record, the majority of the time when these business leaders with all this experience raise significant amounts of venture or private equity capital to launch a business, it usually fails. It usually fails. And we always think it won't fail because it has so much money behind it and it has these great executives. Just going to prove to the audience today that we never know what the combination of the right formula is. And sometimes it's luck. So whereas Quibi had no luck, right? I'm not a Quibi proponent. I don't use the service. I just know the business and the business model a little bit. And I just wanted to highlight that, that is what we just talked about. We're all B to C solution sets and content. So I want to push the audience in conclusion of this topic. It's time for more business models, specifically in the world, not just Silicon Valley. Okay. So it's time to push Hollywood. It's time to push Silicon Valley. It's time to look and see what China's doing and how they're making money on digital media, right? I'm not saying that China's doing it all great. It's just that they did take a little bit different approach. Tencent took a little bit of different approach. It's not big. It's not a big rocket science business model that they came up with, but they're just doing it a little bit different than Silicon Valley. So we can all learn from each other if we contextualize geographies and technology and funding. Okay, to AR, VR.
Actually, Joe, can I just jump in for 1 second? So I got a sort of a question coming in. Could you just sum up what Quibi's business model is for those who are not familiar with it?
Sure, Quibi it is formally done. It launched in April. It was content, new, unique content in studios, studio content caliber for mobile phones, for episodes that are 3 minutes to 22 minutes. And then they aggregated news for you and sports for you, and they had finance. So they aggregated news, sports, finance, which is what Yahoo did 10 years ago, by the way. That was their main business model. So it was very finely tuned towards your taste, but delivered on a mobile phone. And then they had a proprietary technology, so content with technology, that was able to allow your phone from go to horizontal to vertical in real time, and you could still be watching the content seamlessly. Yeah. So that was their technology. And the CTO was Pandora's CTO. They took him from Pandora to Quibi.
Yeah, so I think the question on monetization, I just saw the comment is they were charging it on a subscription-based business model with a free trial up front. For the pre-orders, it was a 3-month. So I actually subscribed to that. It was 90 days of free trial. So I then obviously canceled it. So they had a huge churn out coming out of even these early guys, but the numbers were so lagged because it was 90 days that they couldn't see it. And then for the other people that weren't early on in subscribing to it, with the free trials were getting smaller and smaller, I think down to 14 days or 7 days at the end. They were getting tighter on the timelines, but it was a subscription-based business model like Netflix and others.
It was a hybrid subscription with ads and subscription without ads.
Then they went to a freemium model almost at the end where they started injecting ads as well so that you could have a free option into it. Yeah.
And there's one more caveat.
But early on, they didn't have that. When you signed for the pre-order, there was actually a aggressive wall, like you either continue being and you start paying after 90 days or you can't. But they then sort of pivoted back to that model.
And mid COVID, if we just say 3 months ago or so, they did decide to open it up to non just mobile handsets. They decided to try to do smart TVs as well, specifically with Android. But anyway, so that's Quibi, and they didn't make it, and they're going to give their assets. They're going to sell their assets and give the money back to their private equity firms. Mm-hmm. They raised 1.7 billion, and they're going to give 350 million back and then sell their assets. So most likely they lost $1 billion.
So,
yeah.
AR/VR. Sorry to interrupt you. It was just I wanted to make sure we elucidated that for the audience.
So AR/VR, XR, MR. Choose your acronym. Obviously, they have different value sets and different technologies associated with them. I personally, DNA Partners believes that AR and VR are a significant market to participate in, not in the traditional like goggles way, you know, head mounted display, more of in a sense of a glass or a pair of glasses, spectacles, maybe with another device that doesn't have to be your mobile phone. It could be just a power set or a radio epaulette or a belt buckle or whatever. I know those are those that seem just crazy, but why can't you could just clip something on that could be the power supply and the radio associated with it, and then you really have all your functionality in your spectacle glasses. So we're starting to see from Korea specifically really cool spectacle companies that have a display shoots down from the top, and then it has etched glass in the eyeglass, and then you can watch a full your content in there.
Wow.
And I want to highlight that AR, VR are great, obviously for B2C, but B2B, B2G, a lot of good subsets. Even an architect running around on a piece of property would be great to have that type of solution set. So once again, I want to pull this conversation out of all B2C and think about digital media for B2C, B2B, B2G, other.
I don't have that much to say about AR, VR, just because I just think it's great to see all the innovation and experimentation, but it's just not ready for prime time, and I have no idea when it's going to come. It's going to be a while before it's big enough to be interesting.
In prime time. So
Yeah.
we'll still invest in the napkin sketch.
So I think, I mean, to Joe's point, there's a lot of applicability around it in certain B2B areas, in particular around industrial, a lot of very, very focused solutions that I think make sense for both AR and VR. Looking a little bit at the broad appeal of AR and VR, we look at attach rates of devices, right? I mean, the mobile revolution was possible because of Apple with iOS and Android. We look at the attach rates today. I think Oculus Quest 2 is a great move in the right direction. It's a great proposition. No wires. It's actually relatively cheap for what it is. And, I think we're in the right direction, but the attach rates we see are still not great. So for us, it's not super exciting. We don't really invest in the industrial space. So again, it's appealing, but we focus more around consumer or consumer-like behavior. So stuff that's really mass marketable at a certain point in time.
So here's a fun example of a very old company, but it's an example of industrial AR, VR company that was extraordinarily successful, that the founder became a billionaire. Flight Safety International. Warren Buffett, Berkshire Hathaway acquired that company. That is the ultimate AR, VR company. That is hardware, software, very sophisticated hardware, software to teach pilots how to fly planes, right? And it is a critical piece of equipment. And each simulator is, I don't even know how much it costs, tens of millions of dollars, if not, it's probably not hundreds of millions, but tens of millions of dollars. It is an incredibly capital intensive business, but a very good business, very profitable, very lucrative, recurring revenue model, because every single airline needs to train their pilots and they have to go through their certification over and over again. Incredibly successful business, been around for decades, right? And so you just have to find the right use case, but that is AR, VR right there, right?
Yeah. And timing, I agree that it's not trendy on timing, and that's what we like about it. And that we also like that Google and Facebook, Oculus, have not failed, but they've given it V1, V2, right? And so now it's time, and Sony has given it V1, V2, and now it's time for maybe to shrink it down, and we don't need to use a full phone operating system. Maybe we could use something like KaiOS or Sailfish operating system, or some special watch OS or something. It just doesn't take the horsepower that we need to drive a mobile phone. And I just think a mobile phone is like carrying around a big brick. I mean, you know, I went from the StarTAC to the bricks to this thing, which is pretty big relatively to a StarTAC, right? To the old Motorola StarTAC. So I think it's time for just multi-device, multi-operating system, multi-functions. You don't have to do everything. I don't have to play every single app on my glasses. I don't have to play 1 billion apps from Google Play. It can be more productized towards what your needs are and your business model, and business model and revenue model associated with it. So maybe I just want to download a few movies before I get on the airplane. Maybe I don't need a subscription, another subscription to Netflix, Hulu, XYZ, ABC. I don't need that catalog or that library. So
Yeah.
I think it's time for, shifting functionality on devices and OSs and, maybe more web solution sets, HTML5, it's time for breakthroughs. It's time
Yeah,
for
I agree. I mean, although we are having, I think, a lot of great positive signals with mobile AR kits, both across Android and iOS, and all this stuff, I think is going to propagate AR, certainly from a mass consumption standpoint. I think the fundamental issue is if these things are going to withstand the test of time or not. My belief is that they're not. Now, the question is if we're 5 to 10 years out or not. But for me, the biggest shift that's going to happen, that AR and VR are going to bring to the table, is a fundamental shift around I/O, around input and output. It's how we consume stuff and how we interact with stuff. And these things are very limited. I mean, most of the energy consumption is for the damn screen. So they actually don't work well as a phenomenon of the future. People like us that have glasses, definitely like me or Ho, we're like, why can't we do stuff with our glasses, right? So that's obvious. So again, there have been a lot of attempts. I think we may be still 5-10 years out to a mass revolution, but we're going to have one. There is going to be a mass revolution in input and output.
and the market.
As we're talking about this, I worked at Silicon Graphics in the mid 90s. Like this is so right before I started Altos in 96. I was at SGI from 94 to 96. That was the 3D company, right? We were talking about all this stuff. Yeah, AR, VR, and we using our supercomputers, and those are very expensive workstations, multi-$100,000 workstations to create these simulators, and there were businesses that raised venture funding that had these like kind of sophisticated arcades, sort of like the flight safety thing, but for entertainment. You would go in there and have these immersive 3D experiences, and so there were like innovation happening. That was like more than 25 years ago. Right. So we're still talking about this. It's like it's still off in the future. It's like, my gosh,
it will happen. We just can't predict the timing.
The technology industry has changed the world and has advanced in so many ways. And yet 25 years later, it's like, oh my God, this stuff is still feels like so far away. Like that's why I'm a little bit of an AR VR skeptic, because having lived through it more than 25 years ago at SGI, which was the hottest company in 3D, it's like, we still have a ways to go. Yeah.
Google's on that exact campus, but
yeah,
graphics was talking about glasses all the time or peripherals. But it's another topic. But to step into the future, I want to highlight that Silicon Valley doesn't focus on AR, VR, XR, MR. It's more New York and Korea and other parts of Asia. China, obviously, I know everyone on the panel knows that China does a lot of AR, VR and succeeding at it and selling consumer products in it already. And if you went to the Consumer Electronics Show in 2020, January 2020, there was a lot of AR, VR solution sets that worked, that surprisingly worked, right? So it isn't necessarily in the domain of Silicon Valley. We'll see what Apple and Google and Facebook come out with, but those will all be B2C, really funky looking, really refined by the time they hit the market. So, let's just keep an open mind on new solution sets. And let's keep an open mind on non-platforms that we're used to in Web 2.0, if we want to call it that. Where Amazon, where the FANG stocks are controlling all of our platforms, where we have Web 3.0 of distributed computing. So let's break through that paradigm as well, where they don't control all of our lives. So just another notion to consider.
So maybe pivoting from AR VR a little bit, and I'm mindful that we've got about 10 minutes or so left in this portion before we start the Q&A. I'd like to get your thoughts, Ho and Nunu, on some of the immersive media, the trend that's going on now, whether that's gaming or other opportunities sort of in that space. And I feel like that revolution is kind of going on right now as we speak, and folks are going to be able to tap into it and create some developments.
Yeah. I mean, I would start with blindingly obvious. I think gaming has become huge and mainstream, bigger than several other media industries put together. And nobody's watching, magically, it's like the last 2 years people started watching. I'm like, well, the numbers have been there for a while. I mean, the mobile gaming revolution has sort of amped it up, but we've had a couple of others. The cool thing is, I think, the metaverse. And I do think the metaverse ultimately will get deployed over VR and AR. So, enriched reality in general. But that's, I think, what we're preparing for a world that is alternative, which is a little bit back in time. If we go back to Second Life, what Second Life was trying to offer us and what they were trying to do, I think it will be manifested now in that space. Ready Player One, obviously the movie, and obviously the book before that, showing us what that future might look like. But we haven't seen anything yet. We are seeing what I would call an atomization of the gaming industry. So if we look at taxonomy, we went from very broadly having hardcore games versus casual games to then having casual, mid-core, propelled a lot by mobile, and then hardcore. And within hardcore, we have a lot of different categories like MMORPG and a few others. We're now having an atomization that's happened over the last 4 or 5 years around casual, where we have hyper casual, like almost the opposite of gaming in general, which is not about retention engagement of users, but it's like use it and then we give you another game and then you can use it as well, etc. We have different models that are emerging around skills-based gaming, right? With skills, and companies like Tether Studios and a few others really in that space occupying skills-based gaming. So I don't think we've seen anything yet. The layers around gaming, like esports, which are still very infant, the gaming's around, the layers around basically all the distribution of content around it that Twitch so much was in front of. All of that piece is really still up for grabs. So for us, we spend a lot of time in gaming. I think we're going to see different types of games, much more interactive, much more complex, but also we're going to have a lot more user-generated content coming into gaming. And this whole model of all these ecosystems have their own economies, et cetera, I think also at some point will face some challenges. So we're going to have an issue of interoperability between economies and what's valid and what's not valid. And that will link back to esports. How do we make money if we're pro gamers once we are involved deeply into that content? So a lot of different layers. I know I didn't give you a very structured McKinsey answer. It was more of a laundry list answer, but it's I'm ex-McKinsey, so I should have given you the structured one. But so certainly the laundry list is around that. There's a lot of different spaces that we're looking at. I think we haven't seen anything yet.
Ho, what are your thoughts?
Yeah, we're early innings for sure. Look, our first billion-dollar gaming company is a company called Krafton, which had a hit game called PUBG, and it was a precursor to Fortnite. It's actually bigger than Fortnite on a global basis, really huge in China and Korea. But it's a very immersive experience. You're trying to survive, and you don't necessarily need realism, because Fortnite is really very cartoony, but it's very engaging and it's nerve-wracking. Right, trying to survive and trying to win, and it's skill-based. And PUBG's vision has always been to become an esport because it's very much skill-based. So I think that's an interesting area, and we're still early days. I think PUBG was kind of the first of its genre to be a really big game, and Fortnite is another great example. On the metaverse, user-generated content, our other big gaming company is a company called Roblox, but I can't really comment on that too much. They recently filed for IPO, so we're kind of in a quiet period. But people should check it out if they haven't heard of it. And most people with kids have heard of it, and certainly all the kids know about it. But a lot of adults, if you don't have kids that age, may have never heard of it. It's just kind of grown through word of mouth over the past 14 years or so.
So
it's
I'm
also
mindful
true.
that,
I mean, sorry, just to that, to
please.
the point that Ho was making, it's also true that some of these are not overnight successes. I mean, Epic, Roblox, these companies take a huge amount of time to be built. In particular, if it's significant platforms, they just take a long time to have any traction, and some of them never make it. So for
Yeah,
every
right.
Roblox, you have hundreds of companies that died because
Yeah.
they could never
Yeah.
find a product market fit. And so
Yeah.
it's difficult to also be an early stage investor in the space precisely because of that, because it might take.
Yeah. Epic is a great. Epic's been around even longer than Roblox, right? Yeah. And so, but it's a great business. It's profitable business model. So, Epic until Fortnite never really raised outside funding.
Yeah.
I guess they did take some strategic money, but I think it was mostly secondary from Tencent a number of years ago. Yeah.
Actually, so Nuno, what you said just sort of reminded me of something else, which was that on another panel that you and I were on, I think you talked about how your perspective for figuring out which companies to invest in aren't necessarily even about the companies, but about the market and the market opportunity.
Yeah.
Yeah.
Yeah,
And I think that might be helpful to sort of
Yeah.
share it in this context. And I've
Yeah,
been interested in Joe and Jose.
And I'm preaching to the choir. I mean, Altus Ventures may not be a household name for everyone, but they are an incredible player at actually doing that. What I'm about to say, which is to look at markets well ahead, to make decisions, etc. So, with letting Ho follow up on what I'm about to say, we look at things pretty broadly. I think there's a little bit of a lack of discipline in doing early stage investing and looking at really all the anchors of risk, right? And the anchors of risk are markets, product and technology differentiation, teams. And if you can sort of, have a cheat sheet for product market fit, how could you figure that out early on? And that's one of the things we brought to the table with our first fund in 2010, being very analytically driven very early on. In market, I actually have to say, it's actually one of the areas that early stage funds spend the least time on. Doing outside-in analysis on markets, understanding how competition works, really understanding from their founders if they're looking at those spaces or not. And so maybe what you're referring to is a little bit under COVID, what do we look at? And I have this sort of trifecta of markets that I look at. There's what I call positively correlated and negatively correlated and non-correlated markets that I look at. And it's actually each of them has a different challenge from an investor standpoint. So if you're entrepreneurs, and most of our audience are entrepreneurs, and you're trying to figure out how VCs will look at you from a market standpoint, always take into account which market you fit on. Because if you're positively correlated, you're like, I'm great because I'm a gaming company, everyone's at home, and for some reason this is scaling and going through the roof. That's great. But if we're VCs and we're good at it, we're going to be like, okay, are these numbers biased or not? Have the number tapered off, and then they're going to go through a decline after, COVID is sort of under control, let's say a year and a half, 2 years down the road, whatever the timeline is, because that's the key question that VCs are going to be asking, right? And if you're in the positive correlated space and you're getting no traction, you're like, there's something strange, right? I mean, then your product doesn't have a mass appeal. Organically, it won't grow, et cetera, et cetera. The negatively correlated, it's tough, right? If you're in the restoration, in the restaurant business, if you're in the hotel business, if you're in the travel business, in particular, in some areas of that are very negatively affected, it's very difficult to get out of it. And you have to be ready for the fact that, some investors might just say no to you on the market itself, but you certainly need to have an angle in which basically your company makes sense, not just today, but it will make sense tomorrow. But not just tomorrow, but also today. And that becomes more difficult from a business model and operating model type of view. And what I mean by that is you can't just come out with the grandest of all pivots and say, all of a sudden, we just adapted, we're now a food delivery company. We weren't. But at the same time, it needs to fit into a grander vision down the road. And it's a really difficult angle to do. It's difficult right now to raise money if you are certainly an early stage company. We're not talking about growth stage investments if you're Instacart or whatever. If you are in a market that is, and I would allege they're in a positively correlated market, which is food delivery. But negatively correlated, it would be very difficult for you to make the call. And the final thing is uncorrelated, right? It's not correlated. It's in a space that we don't see much correlation with the current thing that we're happening with the economic cycle and with COVID. There, the key question for the venture capitalist, again, if he's a good investor, will be, is it truly uncorrelated? Or will there be a spillover effect of economic effects down the road whereby we have to stand back? People always classically say defense is always uncorrelated. I'm not sure it is. At some point in time, it might not be, because the funds are going to other pieces of the puzzle that are requiring emergency funding, right? So effectively, how do you think through it? and how do you sort of address those three types of markets is a little bit my trifecta of analysis. And if you're an entrepreneur, you need to look at the other side and empathize with the investor and how they are looking at these spaces.
I just want to do a quick commercial, a positive commercial for Altos. Altos has been in Silicon Valley for a long time. I'm just going to say that because I know the specific amount of years, but always has had a great stable reputation, approachable reputation. That's not always been Silicon Valley, where venture capitalists have always had an approachable reputation. And then I think over the years, they've been able to accommodate looking from the top down, whether it's $1 billion need to the entrepreneur or the $1 million approach to the entrepreneur. That's a unique attribute to a venture capital firm, and they've matured over the years to be able to do that. So I just wanted to highlight that for Altos.
Geez, thank you. I feel surrounded by love here.
Well, it's a unique.
So, our approach is really, at the end of the day, not about markets, even though maybe it feels to people after the fact that we saw certain things coming. We're very oriented around just people and the companies. We're just trying to build really solid companies. And we tend to be kind of contrarian. So I love the example of Southwest Airlines, because it's just the airline is a terrible, terrible sector, right? And Warren Buffett said the Wright brothers should have been shot, from a capitalist perspective, and yet he still managed to figure out how to lose billions of dollars on airlines, even though he's been negative on airlines for years. But Southwest Airlines has been an amazing business, and I think outperformed Intel and Microsoft for there was a 30-year window from the 70s to the 2000s or so, where they outperformed the best stocks. And so, or Nucor Steel is another one. Steel, and who wants to be in the steel industry? Terrible to be in the steel industry, but Nucor was an amazing company. Or retail is a terrible, terrible sector, but Walmart was an amazing company, singularly great company in retail sector. Or geez, who wants to be in the restaurant business? That's a crappy business, right? Fly by nights all the time. Well, Starbucks was a fabulous company and has had Starbucks was one of the investments at Trinity Ventures, which is where I got my first job in venture. And after the IPO, at the IPO, we had about 146 stores. After the IPO, the stock grew another 300x after the IPO. Right now they have 25,000 stores globally. And so you could build, even in crappy industries, crappy markets, amazing companies. So we're always trying to figure out who are the people who can really build amazing companies, and what's the business model. And going into COVID, and I think we were very lucky that we had certain companies that are beneficiaries of COVID, like gaming companies or food. We have a food delivery company that's been a huge unexpected beneficiary. We have a company called Outdoorsy, which is in the outdoor RV rental marketplace. Of course, for a while, it looked like that business was devastated. We lost 90% of bookings, but now it's like one of the few things you could do. So it's just business is booming, right? Even ahead of the pre-COVID plans. So we definitely got lucky, but before we got lucky with COVID, again, we're trying to build solid fundamental businesses, and geez, we've been on a up market for so long, we were kind of nervous, and we're building companies with strong balance sheets, minimal debt, right? So we had billions of dollars on the balance sheet of our top companies, literally billions of dollars, and profitable business models. And for some reason, COVID happened to benefit some of our companies, but if we had some other crisis that hurt our companies and profitability went to zero or negative, we had strong balance sheets, we had cash, right? And if you have cash and you have a profitable model and the world is going through all kinds of disruptions, your business is going to do well, right? You are the business. You could acquire all your competitors. It's easier to get real estate, office space. Before COVID, that was a really tough thing. It's easier to hire engineers. You're not going to have employee churn because some dumb money-losing unicorn company is offering stupid compensation packages for engineers. So if you just focus on the fundamentals of building solid companies, things will work out.
Well, that's fantastic. So we're going to wrap this section. Before we do and pivot into the Q&A, what I'd like is just to give each of you an opportunity to convey anything in sort of 30 seconds you'd like the audience to hear or be aware of, as well as just, again, plug your contact information. I think each of you have listed it in your names, but we'll start with you, Ho, and we'll go Ho, Joe, Nunu.
Well, I think this is a very crazy year, but I think it's time, these difficult times of crises. I said the same thing in 2008, 2009. I thought that was a great time for entrepreneurs, great time to start new companies. And so I think these disruptive moments are difficult for the incumbents. I think for the, incumbents don't like change. For the entrepreneurs, people, we have nothing to lose, right? You're starting from, you're starting from such a low base. It's like, you're already at the bottom. These are great times for entrepreneurs to be starting companies. So good luck to, all these people who are listening. I think this is a fantastic time to be out there trying to start something new.
Thank you. Joe?
Yeah, so I'll just highlight what we're looking at for DNA Partners. We're looking for new business models, revenue models. We are not interested in the advertising, selling people's information. We're very conscious on privacy and security. We always have been. It's instilled in the three of us, all the partners. We're not on LinkedIn. We're not on Facebook. We're not on Snap. We're not on any of these because we don't like the business models. We don't want to be a participant. If they wanted to charge us $3 a month to not use any of our data, great, we'd be a part of it. But they don't want to fray on their business model, so we want to look at new business models. We want to see more operating systems. So of course we'll work with iOS and Android, but really not interesting. Especially Android is not a very good operating system. So we like to look at Pine OS, Sailfish OS, KaiOS. KaiOS is the second largest operating system in handsets in India. So it displaces iOS in India. So take a look at KaiOS, KaiOS, just to hit Wikipedia up on it real quick. We are AR/VR interested. We are DRM interested. China's doing more and more DRM. We're very interested in high resolution companies that focus on high resolution or high definition. We want to work with those types of companies. Maybe they even build their own equivalent to Dolby or something, or put high res and low res and give us a challenge on something new for AR maybe. And we like Unity. We're all about 5G. We've all been in the mobile network operator space for years, so we have an understanding of the huge paradigm shift of 5G if it's executed well and spectrum is allocated. The US is behind in spectrum allocation. Yeah, we're just kind of rounding that out. And then our geographies, we're committed to USA, China, and why the Philippines? We all have experience, the three of us on our firm, we have experience in Japan a lot of experience in South Korea, a lot of experience in Hong Kong and Singapore. Those are great countries to do business with. They're awesome. And they're almost easier to do business than the United States, because you can just go to the government, you can go top down and shop around and get introductions, especially China. But the Philippines, we feel like it just got a third mobile network operator. It's building out its rural system. Their priority to bank the unbanked citizens. Their engineering universities are becoming more sophisticated. So for software engineers, their ecosystem for participants like Cisco has committed a lot to the Philippines. I mean, they commit to a lot of geographies, but so the larger USA companies have started committing more to the Philippines, and then they're proving that their citizens are becoming more developed than undeveloped. So it's just a transition. So like I said, we're early stage investment. We take risks early on. So we're taking a risk with the Philippines, and we're proud of it.
Nunu?
Yeah, so two pieces, one piece of advice and one piece around how to contact me. Best way to contact me is LinkedIn. Do put a note saying that you watched me on this event. Extra points if you've either watched my rejection and adversity as a path to growth video or the podcast. You've listened to the podcast, but happy to accept the invite. If you guys are going to pitch me hardcore, pitch me with a pitch deck or send me something that I can take a look at. I won't say that I will take a call with anyone, so it will really depend whether it fits our thesis or not. I'm normally pretty transparent, hopefully not a brute, but certainly transparent. The second piece of advice is, I mean, I do agree with Ho. This is a great time to start a business. There's very sadly people being laid off and amazing talent being laid off. And so it's also easier to constitute teams and to scale them and do them in a way that I think even financially it's much better than before. You know, rents are coming down, and and you can have a fully distributed team. And VCs, even the VCs that were more hardcore around everyone needs to be in the Bay Area or in one location, are now getting a little bit looser. So it's a really good time to do all of this. I would sort of share an advice on the other side of the table, which is in particular for first-time entrepreneurs. The ones that have done 2 or 3 startups would know this. Being an entrepreneur is really, really difficult, and it's really, really painful. You know, Ben Horowitz, I think, describes it well as the pain of being an entrepreneur and the hard thing about hard things. You have a unique thing in this call, which is you have 3 VCs that are entrepreneurs in VCs, which is highly uncommon. We all started our firms, which is strange, right? Almost. I would not recommend that you start your own VC firms. Probably one of the most difficult types of entrepreneurship, in my opinion. I love my profession, but God, if I knew at the beginning what this would entail, I'm not sure I would have come here. I would have probably kept my cushy jobs in corporate world or at McKinsey. And so, you know, in all honesty, the pain of being an entrepreneur is something that you should take into account, because bad times will come, even if they're not just now. Even if you can raise them around now, you know, like, oh, but Ho did say that now was the difficult time, so it's a good time to raise and whatever. You could still not raise your Series A. You could still not raise your Series B. You could still not scale your team. You could face all sorts of issues. And so be totally prepared for that level of pain, because if you don't go through it, you know, it won't be worth much, right? So again, just get ready for it. As a final point, do your math. Do a little spreadsheet on what you're turning away from. If you're in the Bay Area, you have an offer to go and be a senior manager, a director, a senior director at Google or Facebook, do the math of what that would entail versus doing your own startup, and risk adjust the success of your startup, right? And you'll come to a conclusion that it's rarely worthwhile if you do that math up front. So as I always say, you know, entrepreneurs and venture capitalists may be some of the most mathematically challenged people in the world, because we just make these leaps of faith in terms of returns and what we can get out of it with stupid risks. But do that math so that when you go into your startup, you know what you're giving up for the next 4, 5, 7 years, right? Before you actually get into it.
I think that's fantastic advice. So we've got some time now. We've got about 15 minutes or so for some questions. I'll start reading them off. Maybe this one. Well, I think I know the answer to this one, but would you say that IoT-based intelligent ad distribution falls under media tech? I would think based on our discussion and earlier, the answer to that is yes. So I'm not sure we need to do
yes.
that. You know, how do we see 5G changing the course in media tech, and sort of over what time frame would you see that happening? Open question.
Joe can take it, and I can then disagree with him.
Friendly disagreement. Yeah.
Love it. I think it's from end to end in the architecture of the network itself. So the mobile network operators, whether they're a tier 1 like AT&T or a tier 3 like US Cellular, they're all working now with the hardware companies like Nokia and Ericsson and Samsung to be able to make the network modular. So it's becoming more of a software modular network from end to end. And that's a big step for mobile network operators to share anything with their network end to end. Usually they just want to push it all to the handset or the device and say, work with it over there, and we'll just be the transport and give us a rev share on your handset and your business model. So I think it's connectivity, it's software, it's becoming a software network. It's called software defined network and software defined radio. It's the philosophy of the mobile network operator usually is a closed architecture. I'll say it's with with a strong arm. They're becoming more open, but GSMA, one of the big associations in mobile wireless, said yesterday, the head of intelligence said yesterday, GSMA, he thinks that 25% of the mobile operators will open up more and more in the next few years. So that's not very many, but it gives still an opportunity. So the technology will be there to be modular. And then just the transmission speeds and just be able to push business and revenue models to new heights.
Yeah, I mean, I agree with everything Joe said. I would just add a couple of pieces of nuance. I think Joe knows this. I was actually the head of strategy, corporate and business development for GSM Association. When we were going through the total transformation of GSMA, and there was still a fight going on for 3G, and China wasn't clear, et cetera, et cetera. And so my lesson learned with telecom carriers is I think there will be incredible enablers of a lot of innovation on top of them. But in some ways, 5G might be maybe the nail in the coffin of being a dumb bit pipe. I know I disagree with Joe on this, and so at the end of the day, for me, 5G will at some point enable things that are fundamentally better to the edges. It might actually bring the what I would call sort of the promise of fixed mobile convergence or fixed mobile integration finally to bear, certainly from an architecture standpoint. But we have ways to go on it. We're 5 to 10 years down some scalability on it, and as we have been on LTE, it took a while. So, in some ways, I think it will be better, faster, lower latency. More integration, more convergence and services. It will offer a lot of cool things that will enable media plays and media tech plays. So I totally agree on the points that Joe was making, but it's going to take a while, and in some ways, I think it will be the nail in the coffin for carriers.
5G will be the nail in the coffin?
Yeah, I mean, it's the last nail. It's almost there. It's just one nail.
Oh, for them to not make money.
No, it's not that. It's not the nail in the coffin in terms of them making money. These are cash producing machines. They will continue making money. And it will lead to, in my opinion, in many markets, probably not the US, but in many markets, it will lead to a tremendous amount of consolidation. But it's then a different economic scale. It's like a utility scale that is very cash generative. There's nothing bad with the business. It's just not the business that most telcos wanted to be in. They wanted to be service providers. They wanted to be owners of the world. Some of these guys were my clients. Some of the best carriers in the world were my clients, and they had a shot at it. You actually mentioned some of them today. They had a shot at it, and it's just very difficult to see how they will be the ultimate service providers. They are going to be dumb bit pipes. They're going to be very, very cash generative. It's going to be a good business. It's fine.
So I just want to share with the audience that I've worked for 2 mobile operators, one in the US and one in South Korea. I was an executive at both of them. And, I tend to agree with what Nuno is saying to a degree where it's of their own domain. Well, they'll fumble over themselves and spend too much money. But you look at Sprint since 96 has really never made money. They've been the overpromised, under-deliver service provider to the consumer, never even got their billing straight. But I want to say something very poignant to the audience is that if you want to get something rolling in media tech and mobile, SMS, the protocol will fade away, and what's replacing it is rich communication services. So it's called RCS. And if you go to GSMA,
Rich Communication Suite, yeah.
If you go to GSMA.com and look under rich communication services, you're on your way to starting a simple rich media technology company.
Yeah, I launched that, Joe. It started as personal instant messaging.
Anyway, over to Ho.
2006, yeah. 2006.
Well, fantastic. All right. So next question. Do you have a sense for what opportunities are going to present themselves in blockchain in this space? I mean, I think DRM is maybe one that comes to mind, or at least top of my mind.
I'll start with a very quick answers because I obviously don't want to elongate too much, but I look at blockchain a little bit like AI. And I think in the future, we're going to have blockchain embedded in a lot of things. Like right now we have AI as machine learning in a lot of things. So it will be part of the proposition. rather than the proposition itself. The way I look at blockchain is a little bit like TCP/IP, so it's a protocol that just happens to have almost an embedded business model to it, which there is a remuneration or an incentive economically given to the parties in the system, in particular the miners. So that's how I see it. As I always say, I'm bearish in the short term, bullish in the long term. I think it's going to be a core enabler to many things. I'm, for example, an advisor to a fintech company called Share with an X. And they're using blockchain, but they don't even talk about blockchain anymore. They're using blockchain for what they're doing, but it's just part of their technology stack rather than anything else.
Is there any specific opportunities you all see within media tech coming down the pike?
For blockchain specifically?
Yeah, for blockchain specific.
Yeah, I think you're getting into a new undistributed world. So there's a new network called Tether Network, and they have a coin and everything, and they're building basically a competition to Netflix. So you don't have to be having a subscription-based service, and you'll have a content library that will just be based on a fraction of a coin if you want to purchase it. Mm-hmm. So I think it gets us away from the FANG domains and gets us into true disparate services that we can choose, different types of ways of payment or business models or revenue models.
FANG as in Facebook, Apple, Google.
FANG,
right?
Facebook,
Yeah.
Apple, Google, Netflix,
Amazon.
Amazon.
And then now they're putting FANG plus M, Microsoft.
Yeah.
All right. So another question, and maybe we'll try and throw this to Ho. And I'm in terms of investment outside of the United States, or do you look at making deals outside of the U.S., or is it purely U.S. Bay Area? And then this question is specifically targeted towards Australia, but I want to be inclusive because we've got a broad audience today.
Yeah, well, we did a deal earlier this year in Australia called Insight Timer. This is the meditation platform company, and the CEO actually lives in Bali. So this is before COVID. They were already living a distributed life. We've done a deal in Mexico, a fintech company. We funded 3 companies out of Eastern Europe, out of Estonia, Belarus, and Ukraine. So we will, and we've done deals in Canada as well. So we have done deals outside of the US and a lot of deals outside of Silicon Valley specifically, because a lot of times we're looking for these more capital efficient companies. Really, we've been contrarians, staying away from mainstream Silicon Valley for 25 years. So we've done a lot of deals in Austin, Texas. We have a company in Portland, Oregon, Denver, a couple of companies in Chicago. So we'll be opportunistic. We'll look at companies everywhere, but we do have companies right here in Silicon Valley, San Francisco, San Jose as well. But we will go wherever we find interesting companies, interesting entrepreneurs. And as I said before, we tend to be more company specific, entrepreneur specific, rather than following some market trend or technology trend. Those will always come and go. The thing that I'm always looking for is really founder market fit or founder company fit. It's really, if the founder is so passionate about some particular problem space, right, and that's going to end up being his or her life's work. That's kind of the thing that we're looking for. That's the magic we're looking for. And if it's kind of a more of an opportunistic thing where, hey, this 5G is coming or AR is coming or something's coming, and I'm going to capitalize on that, and I'm going to ride on that wave, that company can be very successful too. And you're going to ride that wave, and you're going to exit, and that's fine. But it's not going to be Sam Walton building a company into his 80s or Warren Buffett still going strong, still working at the age of 90. I don't know why the heck he's still working, right? He shows up to work every day and he says he tap dances to work every day. Jeff Bezos stole his line. Jeff Bezos says he tap dances to work every day. Well, that's Warren Buffett's line. He's been saying that for decades. We're looking for those kinds of crazy people. And when they find their life's mission in a company, it kind of transcends these industry tech trends because they go from trend to trend and the company endures And so we're kind of trying to follow those founders over very, very long periods, basically.
We have been from the outset, we used to call ourselves geo-agnostic. Now we call ourselves multi-geo. Some of our best investments were in Japan and China. You know, App Annie, we invested where they were a Chinese company. Everyone now thinks they're a San Francisco company. They now are, but they weren't, right? And so, you know, for us, it's always been the notion that very clearly innovation is coming from outside the US and it's propagating really fast. So we're looking for things that have broad appeal. We don't look at stuff that we want to be #1 in Australia or we want to be #1 in Southeast Asia. That's not super mega exciting. We want to see things that want to transcend that, where there is a bigger objective than that. Right now, we call ourselves multi-geo. So I would say our big anchors are Europe, Israel, US, and Southeast Asia and the Far East. But obviously, opportunistically, we can do other things. I'd say really skew towards US and Europe and Israel at this stage. But we obviously, with the right amount of interest in the specific market, we would look at that market as well.
By the way, I forgot to plug. I think at the very beginning, I said we have a Seoul office, Korea. Of course, Korea is the most important geo for us outside of the US. We have I think, 4 unicorns in Korea, really a 5th one that's not known yet. And Korea, when we first started investing there, it's like a small market. You know, all the VCs were going to Israel, China, India, Japan. Nobody had any interest in Korea. And so people questioned, can you even have a unicorn? It's like, well, now Korea has, I don't know, 10 unicorns. And we're on the verge of having multiple decacorns. And so there will be companies worth $30, $50 billion market cap coming out of the Korea startup ecosystem. And no one even thought we can have a unicorn in Korea. And so tech is everywhere now. And a little country like Korea could create some interesting companies. So I'm a big fan of Korea. I can't believe I kind of skipped over Korea. Of course, that's our most important geo outside of the US. Yeah.
And Joe, I think you had listed China and the Philippines in addition to the US on your earlier today.
Yep, I just changed it. I did talk about it before Ho went. So USA, China, Philippines, and then just to highlight, I switched my title there and I put my email address in my heading there.
Fantastic. So I think that's about all the time that we have today, unless anyone has a brief comment that they want to share. I think we'll wrap it up.
I had
Nuno,
one
do you
on I
yeah.
think the first question, which is, you know, you're still defining the product and, you know, should we have
Sure,
investor
yeah,
conversations or not? I think in general, the advice you'll get is no, certainly with institutional guys like us, right, who are either VCs, micro VCs, or private equity firms. You know, talking to angels never really hurts, but it would be more around whether the angel can give you a lot of value or there's something that you need from that person beyond just their money. You know, early on, I think the bar for you to raise money has gone up, in my opinion. You need to get something to the table, either an MVP or a beta test or something like that, for you to start raising, you know, real money, 1 million plus. And so I wouldn't spend enough time with investors unless there's a strategic interest in the specific person to help you with something around the definition of the product, et cetera. But again, in general, the advice would be no.
And very quick comment. The one question was for crypto and DeFi regulation associated with blockchain. That's, you know, that's not necessarily media tech. That's a whole nother, talk to Rob about doing a whole nother panel on that discussion.
Well, fantastic. Well, I think it's 1:30 on the dime. Today's panel has been the most positive, effusive panel I think I've had since I've been working with Rod in terms of cross-pollination and sentiment. It was truly unique. I want to thank Joe, Jason, Nuno, Gonçalves, Pedro, and Honam for being here. I want to thank Rob Lau and Idea2IPO for organizing today's event. I want to thank each of the attendees for attending as well. Again, we're making a recording right now and we'll provide it to you in a few days afterwards, provided that you've signed up and you've given us your email address. My name is Jason Putnam Gordon. I'm with Pulsanelli. Thank you very much for attending today. Take care and be safe.
Great. Thanks, guys. Take care. Bye-bye.
Bye.